Hi guys, welcome to another educational video. This time we're gonna talk about the PDarray matrix. So this was a highly requested topic. I put a poll in the Telegram channel. You guys chose this. It was close with SMT, but this one took the cake. So yeah, we're gonna discuss the PDarray matrix this time. We're gonna go over a few things. What it actually is the PDarray matrix? What are the elements inside of this matrix? And why should we use this? And how to utilize the different elements inside this list. So also, as a last point, keep it simple for yourself, which can be hard at times, but let's try to um, go through this as easily explainable as possible because it's pretty advanced stuff. Ice-T has videos about this, but it's really in-depth and long, so I think it's hard for most people to pay attention. So I've tried to keep it simple and short. Um, I learned everything from ICT, so no, I don't take credit for these concepts. So all credit to ICT. So let's start off. So what actually is a PDarray matrix? So it just actually stands for Premium Discount Array. Now this is actually really simple, so yeah, we don't have to stick too long on this topic. It's a price range divided up in premium and discount, and inside this price range you can look at certain uh, the list in the array itself and take trades accordingly. And it actually helps to this PDarray matrix helps you to determine daily bias. It helps you to determine draw on liquidity. So it's pretty important to know how to utilize it. So why should we use it? Just like I said, IPDA or interbank price delivery algorithm um, seeks to rebalance imbalances and go to unmitigated order blocks or breaker blocks or mitigation blocks. So actually by saying this you already can see how we should use this, and that's how, to determine the draw on liquidity, which can be pretty hard for most people, and to determine the daily bias. I have videos about this both on my YouTube channel, so go check them out if you're not comfortable or not knowledgeable yet about them. So yeah, IPDA seeks to rebalance imbalances, which is my preferred technique to see what the daily bias could be, or the draw on liquidity. Now, not all the elements of the list are always available, so you're gonna see in a second why that is. So here's an example. I've divided up two swing high and swing lows into ranges, and this is how you can determine in what kind of area of price you are trading in. So the first area, swing low to swing high. So now we have a new range created. Where does price wants to go? Price wants to go back into premium before we're gonna go back into discount, right? So with bearish order flow, um, it's easy to spot where to take a trade from. Price doesn't need to go up high in premium. As soon as it touches premium, it can sell off already. And a perfect example actually is here. You see literally the wick went into premium uh, just slightly and just sold off. That's all it needs. You don't have to go into OTE levels, uh, which is preferred for my style and my model. So I would not catch this, but this again, this is a daily time frame. So you need to wait for confirmed swing and highs and lows to draw out your range. That will probably be another topic for another day, how to draw out correct price ranges. So just short, swing low should have 4 candles, one higher, one lower, one higher, and then the fourth candle needs to trade higher than the previous one, and then you have a confirmed swing high, swing low. I mean. So 2 ranges. IPDA refers back from 20, 40, and 60 days in time. So if you cannot find a recently created high or low in that 20 days, you look back further and go back 40 days, and if you find a swing high or low, then you can determine your price range. So let's go through the elements of this list. Pretty simple list. Honestly, you can probably, after practicing a few times, you can remember this already. But we start off, of course, with the highest of premium, which is an old high. And the further down you go into the list, the the less premium it will get. So the highest premium is old high. Then we go into a rejection block, which is this at the swing high with the long rejection wicks. Then we have a bearish order block, and this is from premium to discount, right? So we could have from discount to premium too, but then it's a bullish order block. So we have bearish order block, we have a fair value gap, which is my favorite kind of PDarray. Liquidity void, so that's actually just a drop or a move up in price, which is large. And the fair value gap is a little bit smaller than a liquidity void. Then we have a breaker block and a mitigation block. So people get confused sometimes on which is which. Let me just break it down real quick, and it's simple. A breaker block is only a breaker block if it takes liquidity before and then breaks structure after. Alright, so remember that. So a mitigation block doesn't have to take out, for instance, a bearish mitigation block doesn't take out the most recent old high and then drops down and breaks structure. So that's a mitigation block. If a breaker block goes above an old high and then drops down to break structure, it's becoming a breaker block. So that's a quick explanation of that one. So let's go to example of this list, like we just saw. We saw the old high, rejection block, bearish order block, fair value gap, and etc. So let's look at what is happening right now. So we have an old high, right? So this is the highest of premium. That's where the premium zone ends. Then we have a rejection block. So that's that wick, what I said, a larger wick that's attached to this order block. Now this order block is 3 candles long. It doesn't have to be one candle. If there's three up closed candles before the down move, all those 3 candles are an order block. On the daily time frame, that can be a little bit hard to trade off, but that's how you refine on the lower time frame to see where you can get an entry. Now we have a breaker block, so this one. And why is it a breaker block? Like I just said, we took liquidity up here and then broke down. So this is a breaker block, not a mitigation block. Now, what are we missing over here? We're missing a mitigation block, so not everything on the list is always present, right? Like I just said. So there's also no liquidity void, there are just fair value gaps. And this is all in premium, and when we go back down into discount, we have old low, and actually all these down close candles can be an order block, but the order block is only valid when there's an imbalance after. So you can see this order block has a good down move with imbalances, so this is a confirmed order block. So how are we gonna utilize this this list? So at first you want to determine your price range, right? So look back on the daily time frame, 20, 40, 60 days. Look for your old high, old low. Put your Fibonacci on it, and everything below the 0.5 of that, so the halfway point of the Fib is discount, and everything above it is premium. So that's pretty easy to do, right? So divide the range into premium and discount. Now the harder part, determine the draw on liquidity. You can use this list to determine the draw on liquidity. Price seeks the most optimal PDarray, the most efficient delivery, the most easy to reach PDarray. So if there's a lot of like internal range liquidity, which can be used as resistance, for instance, to go back to premium, it's going to be harder to draw up in premium, and vice versa for discount. So let's look at this example. Still with the same annotations, right, with the old high, rejection block and everything, but now we're actually using bigger range because the move happened from here. Yes, we had in this 20-day period we had a new swing high, but if you look at this whole range, the recently low created from 40 days is actually this high to this low. So we have a bigger range right now, and it makes sense if you're gonna look at price. So price reacted off this breaker block, right? There was also a fair value gap coupled up here. So again, couple it up with a breaker block and an order block and a fair value gap, you have a high probable area for price to sell off from. Now let's start off from the beginning. Like when we created this swing low, we left a little bit imbalance. So we're moving up, heading into inside this fair value gap. See, so we are rebalancing price right now. Now we're gonna go back down. Where do we want to go? We want to rebalance this area. So we're going from imbalance to imbalance. Now we've not fully rebalanced it, but price doesn't have to fully rebalance to move away from that area. And it's actually higher favorable if it doesn't fully rebalance and move up, but that's a topic for another day. So now price is fully rebalancing this order block, a fair value gap, my bad. Then we're going into another fair value gap, and now we're rejecting. We're creating a new swing high, trading through this recently created imbalance. So soon as you see a PDarray getting disrespected, you can already determine draw on liquidity, and your bias should be bearish in this instance. Now why is that? PDarrays needs to be respected for order flow. So if you're in bullish order flow, you want to see bullish fair value gaps, bullish order blocks getting respected, and then move up. So your bias is still in with the correct order flow. Now this bullish fair value gap got traded through, so it's being disrespected. Let me go back. So now, when we disrespect this PDarray, we're definitely can be certain, or at least to a high degree, that where order flow is changing, because it should have rejected from here. So now it's rejecting. Where's price gonna head into? Price wants to go to rebalance this area, which was tapped into but not fully rebalanced. Price went into it, rejected a little bit, but now still trading down, right? Because we're disrespecting this bullish fair value gap, so order flow is bearish. Now, where does price wants to go? Price wants to go into discount and take out an old low, which happened over here. Now we have a new swing low created. So price is fractal, remember? So there are multiple ranges in this big range. Now where does price want to go? What is unmitigated? So we have a fair value gap over here. That's where price wants to draw into, because we need to rebalance, right? Now this order block and this breaker block was not touched by anything, because this candle traded through it. This candle didn't touch the breaker block, and we still went down. So this is unmitigated area of price, and price wants to go to unmitigated price levels or imbalances. We tapped into the breaker / order block and sold off. So we mitigated it. Now we're moving down again. Where does price wants to go? Wants to go to this bullish fair value gap, right? So it fully rebalances. Price actually closes inside it, so that's an indication it could hold. Now you have to be patient. When this kind of stuff happens, you really want to see a new swing low created for you to be back into bullish order flow. So you wait for the next daily candle. What is the next daily candle gonna do? Next daily the candle is going bearish, so the bias should still be bearish. We take out this old low. We're forming the bottom of the whole range right now over here. So now when you see these candles, where's price want to go? Price wants to go inside this fair value gap. It needs to rebalance imbalance, so it goes from imbalance to imbalance. Remember that, guys. So we're trading up into that, fully rebalance it, and now this is current day actually of recording the video. What is the most high probable thing that should happen? We're still trading inside this fair value gap. So two things can happen right now. You want to see this candle trade above this fair value gap, and then you can be more certain it will draw into this old high. If the next daily candle, today is Easter weekend Friday, so volatility won't be present today, so gotta wait probably in a few more days for it to show its hand. But when price closes below this, you can assume draw on liquidity is going to be this low, and when price closes above it with the candle body, remember, very high chance we're gonna take out this high and go back into a higher premium, which has unmitigated areas of price. Remember, unmitigated areas of price. There's a fair value gap, unmitigated. if order flow is bullish, we're gonna reach for those price levels. So that's how I determine where I should use my PDarray matrix from imbalance to imbalance, and see what gets respected and what doesn't get respected, and then you can determine your order flow. So guys, don't try to add more fancy stuff than you need to, because the more things you have on your chart, the harder it will get to read price, in my opinion. I like to have clean charts. Go into a higher time frame point of interest, for instance a fair value gap, right? Don't go into the lower time frame and use your personal model for an entry. So yeah, the PDarray matrix will help you determine draw on liquidity, like I just explained. So I hope you find this video helpful. We did it in like 15 or 16 minutes, so ICT videos about this are actually like 2 or 3 hours long, so there's way more to it, but I've tried to explain it as simple as possible. Yeah, so if you found this video helpful, you can leave a comment, put a like and subscribe, of course, if you want to. It really helps out the channel. We're really growing hard as of late. I also have a free Telegram if you want to join that. I would put a link in the description. I do daily analysis. It's pretty accurate last couple months, so you're really missing out if you're not in it. So yeah, thank you guys for joining this video, and I will speak to you in the next one.